Good morning to everyone. I just spent the last month traveling the world, from Tokyo to Singapore, Hong Kong, passing through Madrid, Paris, London, and New York. I had the opportunity of meeting policymakers, central bankers, CEOs of financial institutions, and many entrepreneurs. What's my key takeaway message? The first one is that Xi Jinping is cutting costs. He's been cutting salary for basically policemen, teachers, nurses, doctors. So its common prosperity is not just cutting Jack Ma Alibaba stake, but also cutting salary across its nation. That means that the Chinese consumer feel weakened, it's uncertain, it's not consuming as much, and as a result, the number one engine of growth in the world, China, over the last 10 years, it's slowing. That means in the coming years, we'll have less growth simply because the number one engine is slowing. China, at the same time, is re-exporting deflation, has overinvested into many industries, domestic consumption is weak, and as a result, it's exporting again at cheap prices, and as a result, it's being again a deflationary driver across the world. In Europe, demand is very soft, volume are shrinking across industry, and so are prices. In the month of October, Denmark posted 0% inflation. If you look at Denmark, inflation correlation to the EU inflation has always been 100%. So I do expect inflation in Europe to trend towards zero into next year. That means ECB rates have arrived and they're done. And I think the ECB is wrong in talking high inflation and high rates for longer, as they were wrong 3 years ago, saying that inflation was temporary. So they were late last time in hiking rates, and they are late this time in cutting them off. Wrong first, wrong second. That means Europe is slowing, and we will see less growth into next year, and we'll see another growth issue across Europe. In the US, growth is slowing very fast. The US has been hanging in thanks to an 8% deficit. But the reality is today, the public debt to GDP is higher than 120%, not to mention unfunded liability, which is more than 800. And in the third quarter, US growth has slowed massively. That's because the 8 to 9% mortgage rates is now having a huge impact on the real estate sector, not just in the US, but also in Europe. And as a result, whoever is on leverage is now feeling strong pain. We've seen WeWork defaulting, we've seen Banco in Austria with its European empire defaulting, and you'll see more casualty in the core real estate sector, which is over-levered. The same applies to any other sector with high leverage. So in the US, what we discovered is that in the third quarter, input prices, ex wages, basically are flat year on year. That means the Fed has achieved its mandate in slowing inflation down. There is still a renegotiation of salary simply because of the last 10, 15 years, capital took too much of the lion's shares of the profit margin vis-a-vis labor, which is actually positive, a redistribution between capital and labor, because if you think about it, capital in the last 10 years has redeployed 70% of its profit in share buyback, which only benefits 10% of US population. And as a result, we think it actually creates a better, more sustainable economy if more of the returns go to labor than just capital. So this is a healthy rebalancing. That means at the same time, though, that we can't expect into next year the same level of growth as we had so far in nominal terms. Conclusion, I think you want to go long duration in high quality assets. In Algebris, across our strategy, we are between 7.5% and 10.5% in dollar. So play safely, high quality fixed income assets, extending duration, in the range of 3 to 5 years, and basically lock in a carry. At the same time, be wary that the US stock market has a risk premium of 3%, equal basically to the 10-year US. It's obviously that if you have no risk on a 10-year US Treasury vis-a-vis risk on the stock exchange with earnings multiple that could contract, and top line itself that might suffer, my preference will be for the US Treasury vis-a-vis the broader US market. All in all, I think it's time to play safe. Our message is inflation has peaked, so we think global rates. Hence, stretch duration, high quality assets, and if you can earn double-digit return in the safest financial around the world, it's time to go.